Did you know Canadian millionaires legally own almost nothing? No houses, no cars, nothing in their personal name. But they control everything. Here is why. Most Canadians are taught, pay off your mortgage, own your car outright, everything in your name equals security. But the wealthy? They think the complete opposite. And once you understand why, you will never look at money the same way. Because here is the truth. The moment you own something personally in Canada, you make it taxable, seizable, and vulnerable. If you want Canadian tax strategies explained like a normal conversation, hit subscribe. And if, by the end, you think this is not for you, you can unsubscribe faster than the CRA can change your tax bracket. Fair? The wealthy do not focus on ownership. They focus on control. Let me show you what I mean. Picture two Canadians, both driving a $70,000 truck. Person A bought it personally. Person B's corporation owns it, and they use it for business. If both get sued tomorrow, Person A's truck? Gone. It is a personal asset. Person B's truck? Cannot touch it. Different owner. Same truck. Completely different risk. Under Canadian law, a corporation is a separate legal entity. Your company can own assets. You control the company. This is not a loophole. It is literally how incorporation works. Now you might be thinking, this sounds complicated, or that is probably not for people like me. The wealthy have that same voice. They just recognize it as noise. They notice it, acknowledge it, and act anyway. Because confidence with this stuff does not come from feeling ready. It comes from taking action. So why do wealthy Canadians avoid personal ownership? 3 reasons. Reason 1. Risk protection. If it is in your name, it is exposed. Lawsuits, business failure, divorce, CRI disputes. If it is not in your name, as accountants say, harder to take. Not impossible. Just harder. Reason 2. Tax timing. This is the one most Canadians completely miss. It is not about dodging tax. It is about when you pay it. Earn $100,000 personally. Income tax hits immediately. CPP, a lie. Provincial tax, all calculated before you see a dime. Earn $100,000 through a corporation. Corporate tax applies first. Yes. But after that, you control when money becomes personal income. You can smooth income across years to avoid higher brackets. Pay yourself dividends at lower rates. Reinvest pre-tax dollars into growth. Use the lifetime capital gains exemption. When you sell, same money, different timing. And in Canada, timing is everything. Reason 3. Leverage and growth. When money stays in a corporation, it compounds faster. Not because the investments are better, but because less money leaks out to taxes along the way. A corporation buys a rental property in Calgary. Rent comes in, stays in the company, pays its own costs, builds retained earnings, funds the next down payment. Compare that to doing it personally. You pay tax first, then invest what is left. Same rent, very different speed of growth. How wealthy Canadians actually structure this. Once you understand the why, the how becomes simple. It is not magic. It is just using Canadian corporate law properly. Rule 1. Run your corporation like a corporation. Sounds obvious, but this trips up most people. Keep separate bank accounts. Do not blur personal and business expenses. Keep proper records, contracts, invoices. If you are using your business credit card for groceries because you forgot your personal one, you are weakening all the protection you set up. CR calls this piercing the corporate veil. It is accountants speak for. Congratulations, you are now personally liable. Rule 2. Watch personal guarantees. Canadian banks love personal guarantees. Sign one, and your limited liability disappears. The debt becomes yours. with your house politely standing behind it. Wealthy people use the corporation's track record, assets, or holding company backing to negotiate around these. And if they must sign, they negotiate limits and get insurance. Before signing any lease or loan, ask yourself, is this in my name or the company's? Rule 3. Insure the structure. The wealthy do not just insure the business. They insure how it is set up. Directors and officers insurance. Professional liability. Legal expenses coverage. Because litigation is expensive, even when you win. Rule 4. Do not keep everything in one company. This is where structure really earns its keep. The wealthy do not keep trading, property, and investments all in one place. One company for real estate, one for operating business, one for intellectual property. Why? Because if one gets sued or fails, the others stay protected. Many of our property clients in Ontario use separate corporations for each property. That way, if there is a problem with one rental, the others are completely isolated. How do you actually use the money? Okay, so the company owns everything. How do wealthy Canadians actually access the money? 3 main ways. 1. Salary. Usually just enough to stay within CPP thresholds and maintain RRSP room. This is not where the wealth comes from. 2. Dividends. Paid from after-tax corporate profits. Taxed more favorably than salary because of the dividend tax credit. This is where most owner income actually comes from. 3. Shareholder loans. Short-term cash flow tool. The corporation lends you money. As long as it is properly documented and repaid within the CRA's timeline, no immediate tax hit. Done right, it is useful. Done wrong, it becomes an expensive tax problem. The key? You are taking money from a separate entity, not just your personal account with extra steps. This is not just for the ultra-wealthy. If this sounds like something only millionaires can do, it is not. Every Canadian business owner, freelancer, and investor has access to the exact same tools. Same corporate law, same CRA rules. You do not need offshore accounts or a lawyer named Sebastian. This usually becomes relevant when your profits hit $60, K $100, K. Cash is building up. You are thinking about growth or property. You are planning an eventual exit. You do not need to be rich to think this way. You just need to be intentional. The real difference. Wealthy do not just structure things differently. They think differently. They act before they feel ready. The hextent for prefer, for. If build systems, they stop trading time for money. They treat mistakes as feedback, not failure. The structures come later. The habits come first. If you live in Ontario and want to plan like a wealthy retiree, you can either scan the QR code or click on the link in the description to see if we are a fit.